Welcome to the deep dive. Today, we're zooming in on a global giant you definitely know, Pepsi Co.
Yeah, Lay's, Doritos, Gatorade, Pepsi itself, Quaker, SodaStream, they're everywhere.
Absolutely. So our mission today is to really unpack PepsiCo's 2024. We want to understand their business segments, look closely at the financials, and get a sense of their strategy moving forward, all based on their latest annual report.
And it's interesting how they get those products to you, the consumer.
Yeah.
It's this mix of direct store delivery, shipping to big customer warehouses, using distributors, plus, their own direct-to-consumer online sales are growing too.
Quite the web. Okay, let's get into it. Where do we start understanding their structure?
Well, you've got to look at their 7 main segments, at least for 2024. There's Frito-Lay North America, FLNA, that's the big snacks division in the U.S. and Canada.
Right, the chips and stuff.
Exactly. Then Quaker Foods North America, QF&A, think oatmeal, cereals, also U.S. and Canada. After that is PepsiCo Beverages North America, PBNA, all the drinks for the same region.
Okay, so 3 for North America. What about internationally?
Yeah. Then you've got Latin America, or LATAM, then Europe, then AMESA, which is a big one, Africa, Middle East, and South Asia. And finally, APAC, Asia Pacific, Australia, New Zealand, and China.
So a truly global footprint, but I heard there's a change coming.
That's right. This is important for tracking things going forward.
Right.
Starting Q1 2025, they're combining FLNA and QF&A.
The 2 North American food businesses.
Correct. They'll become PepsiCo Foods North America. PBNA, the beverage side, stays separate, though.
Ah, okay.
And they mentioned that historical segment numbers will be restated starting Q1 2025, so you'll be able to compare apples to apples, hopefully.
Good to know. So how did they actually do overall in 2024, given that structure?
Well, considering the environment, it was pretty resilient. Organic revenue was up 2%. Not huge, but positive.
And what kind of environment are we talking about? What were the main hurdles?
Oh, plenty. You had ongoing supply chain hiccups, inflation hitting costs, and maybe consumer wallets. Tastes constantly changing. Competition is always fierce.
Right.
Plus, the whole shift to e-commerce, global economic uncertainty, political stuff, and navigating complex regulations everywhere was a lot.
Definitely sounds challenging. But despite that 2% organic growth, how did the bottom line look?
That's where it gets more impressive.
Yeah.
Their core constant currency EPS, that's earnings per share, was up 9%.
9%.
Yeah, and get this, it's the 4th year in a row they've either met or actually beaten their own EPS targets.
So consistency there.
Definitely. And they also pointed out, looking back 5 years, net revenue is up 37% and core EPS is up 48%. So there's solid long-term growth.
Okay, so how did they manage that in such a tough year? What was their playbook?
A big focus was on productivity, just making everything run more efficiently. They were also really doubling down on being consumer-centric, trying to give people what they want.
And that PEP Plus thing comes in here too, right?
Exactly. Pep Plus Pay, PepsiCo Positive. It's kind of their guiding star for all this. It's about sustainability, better products, the whole package. Not just talk. It seems embedded in their strategy.
Okay, let's drill down into those segments then. How did Frito-Lay North America, FLNA, fare specifically?
FLNA saw a slight dip, actually. Net revenue down 1%.
Oh, really? Why was that?
Mostly because organic volume was down about 2.5%. Fewer bags sold, essentially. Yeah. They did use pricing effectively, which offset some of that volume loss, but not all of it.
Interesting. Any particular brands driving that volume decline?
Yeah, the report mentioned declines for some big ones. Cheetos, Tostitos, Lay's, even the variety packs.
Core stuff.
But on the flip side, brands like Chester's and Miss Vickie's actually saw volume growth.
So a bit of a mixed bag within snacks. What about their profit?
FLNA's operating profit took a bigger hit, down 7%. That was because of higher operating costs, partly from investing in new initiatives, plus that volume decline we mentioned.
But productivity helped a bit.
Productivity savings and the net pricing did help cushion the blow, yes.
Okay. Now, what about QF&A, Quaker Foods? Sounds like they had it rougher.
Yeah, QF&A had a really tough year. Net revenue dropped 14%.
14%? That's significant.
It is. And organic volume was also down 14%. The main driver here was the Quaker recall, that voluntary recall they did for certain granola bars and cereals.
Ah, right. I remember that.
It hit hard. They saw big volume drops across bars, oatmeal, pancake syrup, and mix, ready-to-eat cereals. Pretty much across the board for the affected categories.
Yeah.
Recalls can really shake consumer confidence.
No doubt. Okay, what about the beverage side in North America, PBNA?
The report doesn't give the same financial breakdown for PBNA in this section, But we know the portfolio is massive. You've got Aquafina, Bubbly, Gatorade.
Gatorade's always launching new things, like that hydration
That's
booster.
not like Mountain Dew, Pepsi, obviously. Plus their partnerships like Lipton with Unilever, the Starbucks ready-to-drink coffees, and they license brands like Dr. Pepper, Schweppes in certain channels.
And didn't they sell part of Tropicana?
They did. They sold a majority stake in Tropicana Brands Group a while back, but they kept a 39% interest. And crucially, PepsiCo is still the exclusive distributor for TBG in important channels like small stores and food service in the U.S. That distribution muscle is key for PBNA.
Makes sense. All right, let's go international. Latin America.
LATAM saw a tiny net revenue increase, just 0.5%. Pricing helped, but they got hit by unfavorable foreign exchange rates, about 3% negative impact. And overall organic volume dipped slightly.
How did that break down between food and drinks?
Convenient foods volume was down 2% overall. Some countries like Peru and Argentina declined, but Brazil grew. Mexico was also down a bit in snacks. Beverages actually grew slightly overall, driven by Brazil and Mexico, but Colombia, Argentina, Peru saw declines.
A real mix. And profit in LATAM.
Operating profit there decreased slightly, hit by operating costs, a specific indirect tax issue, that volume softness, more ad spending, and currency headwinds again. But, like elsewhere, pricing, productivity, and actually lower commodity costs helped offset some of that.
Currency seems like a recurring theme internationally. How about Europe?
Europe was a brighter spot, net revenue up 5%.
Oh, nice. Was that just price increases?
Nope, it was both effective pricing and organic volume growth. So good underlying demand there. Still had a bit of a currency drag, about 2% negative impact, but solid performance overall.
Good to see. And AMESA, Africa, Middle East, South Asia, that huge, diverse region.
AMESA was up 1% in net revenue. Again, driven by both pricing and some organic volume growth. But, wow, the currency impact there was massive, a 9% negative hit.
9%. Ouch.
Yeah. Within foods, South Africa and India showed growth, but the Middle East and Pakistan declined. Beverages were up 1% overall. India was strong, but again, Middle East, Pakistan, and Nigeria saw declines. Very varied performance across that region.
And the last segment, APAC, Asia Pacific, Australia, New Zealand, China.
APAC had a strong showing. Net revenue up 6%, driven by both organic volume growth and pricing. Seems like that region held up well.
Okay, so a really diverse performance segment by segment. Let's pull back to the total company financials now. What were the headline numbers for 2024?
All right, the big picture. Net revenue nudged up slightly to $91.85 billion from $91.47 billion in 2023.
So pretty flat on the top line.
Basically, yeah. But gross profit increased a bit more to $50.1 billion from $49.6 billion, and operating profit saw a healthier jump up to $12.9 billion from just under $12 billion.
Okay, so margins improved a bit.
Seems like it, and that carried through to the bottom line. Net income attributable to PepsiCo rose 5.5% to $9.58 billion.
And per share.
Diluted earnings per share, EPS, was up 6% to $6.95.
So solid growth there.
Were there any unusual items affecting those profits?
A couple mentioned. Their pension and retiree medical costs went up by $272 million, mostly due to some plan changes and settlements. Net interest expense also increased by $100 million.
Any causes?
While their effective tax rate decreased slightly from 19.8% in 2023 to 19.4% in 2024, which helps net income.
Got it. Now, cash is king, right? How did their cash flow look? Very healthy. Cash flow from operating activities was $13.7 billion for the year. That's up nicely from $12.2 billion in 2023.
And what are they doing with that cash? Investments.
They spent $5.3 billion on capital expenditures. Factories, equipment, technology. That's essential for innovation and keeping things running smoothly.
So operating cash flow minus that capital spending gives you free cash flow.
Exactly. That's how they define it. Plus any cash from selling off assets. And they stress that this free cash flow is what they use for things like acquisitions, paying down debt, giving dividends back to shareholders, and buying back their own stock. That level of CapEx shows they're investing for the future.
And we should probably circle back to that Quaker recall impact on the financials.
Right. That resulted in a pre-tax charge of $187 million in 2024. After tax, it was about $143 million, which translates to roughly 10 cents per share off the bottom line. A definite hit.
The report also talks about non-GAAP measures, like that core constant currency EPS you mentioned earlier. Why do they emphasize those?
Companies use these non-GAAP or core metrics to try and show the underlying performance of the business, stripping out things they consider unusual or one-off items that might make year-to-year comparisons difficult.
Like what kind of things?
For PepsiCo, it could be adjustments for mark-to-market gains or losses on hedges, restructuring costs, acquisition impacts, impairment charges, that product recall, maybe some pension adjustments, effects of tax law changes, things like that.
So it gives investors a different lens.
Exactly. That 9% growth in core constant currency EPS is meant to give you a clearer view of the operational momentum without the noise from some of those other factors.
Makes sense. Okay, let's talk shareholder value. How are they returning cash to investors? Dividends.
Definitely dividends. PepsiCo is known for being a reliable dividend payer, often increasing it over time. The report doesn't specify the exact 2024 amount here, but it's a core part of their strategy.
And share buybacks.
Yes, they're active there too. They have a $10 billion share repurchase program that was authorized in early 2022 and runs through early 2026.
Were they buying back shares recently?
They were. In the last part of 2024, specifically between September 8th and December 28th, they bought back about 1.4 million shares.
For how much?
Total cost was $243 million. And as of the end of 2024, they still had about $6.5 billion left under that authorization.
So plenty of room to continue if they choose to.
Right. It shows they're using both dividends and buybacks to return capital.
So wrapping things up, looking ahead, what's your assessment? How is PepsiCo positioned?
Well, look, the challenges they saw in 2024 aren't just going away. Supply chains, inflation, competition, consumer shifts. That's the reality.
Right.
But their focus seems to be on resilience, adaptation, innovation. That PEP Plus strategy is central prop race of transforming the supply chain for sustainability, like using more regenerative agriculture practices or recycled plastic.
And evolving the products too.
Yeah, pushing more better for your options like we saw with Gatorade, or even acquiring brands like Siete Foods or taking full control of Sabra. They're trying to meet changing demands.
And those big organizational changes in North America we talked about.
That's key. Combining the food businesses is a big move. They're hoping it will help them understand consumers better across categories, find efficiencies, streamline things, and ultimately grow faster by leveraging that combined scale. Similar thinking behind the international realignments, too.
But it's not all guaranteed success, is it? The report mentions risks.
Oh, absolutely. There are always risks. Demand could soften, competition could intensify, powerful retailers could squeeze them, geopolitical events can cause chaos, economic downturns hurt everyone.
Strategic moves could fail, taxes could change.
Exactly. Commodity prices, supply chain disruptions, those are always there. They have a risk management frameworks, of course, from the board down, and they're continuing a big productivity plan through 2030, which costs money up front, but aims for long-term savings.
Anything specific that stood out as a potential watch item?
One thing noted was SodaStream. Its goodwill value on the books is only narrowly above its carrying value. That means if SodaStream doesn't perform as expected or the economy sours, they might have to take an impairment charge down the road, something to monitor.
But overall, the company sounds confident.
They project confidence, yes. They believe in their brand strength, their innovation pipeline, marketing muscle, product quality, and especially that huge distribution network to keep competing effectively.
Okay, so let's summarize. PepsiCo navigated a tricky 2024, managing slight revenue growth but delivering strong earnings growth. They're clearly making big moves with PEP Plus and restructuring to adapt for the future while keeping shareholders happy with dividends and buybacks.
That captures it well. Which brings us to a final thought for you, the listener. Considering how fast consumer habits are changing and these major investments PepsiCo is making in sustainability and reorganization, what do you think will be the most crucial factors driving their success or potential failure in the next few years? And what new challenges might these big strategic shifts themselves create? It's certainly a fascinating company to watch.